Hello to everyone and welcome to today's presentation about the paper Should I Stay or Should I Go? Founder Power and Exit via Initial Public Offering, written by Vangelis Souitaris, Stefania Zerbinati, Peng, and Dean Shepherd. The head author, Vangelis Souitaris, is a professor of entrepreneurship at Cass Business School, City University of London, and the University of St. Gallen. He received his PhD from the University of Bradford, and his research is in the field of entrepreneurship, including entrepreneurial decision-making, entrepreneurial finance, and academic entrepreneurship. The paper was written or published in 2020, and it only has so far 8 citations on Google Scholar, but since it's only published this year, this is still a very good score in terms of citations. The paper is published in the Academy of Management Journal 2020, volume 93, number 1, 64 to 95. The Academy of Management Journal is a peer-reviewed academic journal covering all aspects of management. The mission of the Academy of Management Journal, AMJ, is publish empirical research that tests, extends, or builds management theory and contributes to management practice. It has a VHB factor of an A+ and an impact factor of 7.191, which is considered a very good impact factor, and the VHB ranking of A+ is the highest ranking achievable, so the journal the author published within is a very respected journal. I would like to start today's review with the quick summary about the paper to give you a little bit more insights what we're talking about later. So why is the event of an IPO really relevant? It's relevant because founders can voluntarily exit their ventures via an IPO because there's a lot of cash involved, and when stocks are available on the stock market and you can trade them, you can sell them basically at any point. The only thing you have to take into consideration is a lockup period. This period means in this time frame you're not allowed to sell your assets within the company. But we're going to talk about that later. So this study builds on power theory to assess the impact on potential exit opportunities. And the authors use 2 different approaches to validate the data. In numbers, they use data from 313 founders from 177 entrepreneurial IPOs, and they got those data from the London Stock Exchange, from the archive data. So what they're aiming for with this paper to contribute to the research, first, they would like to provide new insights why founders leave their company. Second, prior research only takes an all or nothing exit into consideration, and we're going to learn later that there are a little bit more shades of gray, so we're talking about partial exits. And the third one, they like to introduce a new factor to the equation when it comes to power, namely the mediating effect of frustration when it comes to the decision to founders to exit their companies. And I'd like to continue to give you some definitions which might make it easier for you to understand what we're talking about. So first, let's start with the definition of power. In the context of top management, power refers to an actor's capacity to exert his or her will on organization, decision, and actions. In this paper, we're talking specifically about 4 different types of power. First is the structural power. This is basically you're the CEO on the hierarchical level. You're the top one, so you have the power, obviously. The second one is ownership power, which refers to who owns the company. If you own the company, even you're not in a managing position, this still has some power to it. Then the third one is the expertise power. Expertise power means if you're very skilled in a specific area or niche, then your power is that knowledge. And the last power is the prestige power, which we can take by media coverage or prior positions into consideration. So if there's a founder who has high media coverage and everybody knows them, he has definitely some prestige power he can add. And the next step, I like to do the definition of an IPO, the initial public offering. It creates a liquid market for venture stock. It creates an opportunity for founders to voluntarily exit their ventures. And the last definition I'd like to give you is the CEO dismissal. A CEO dismissal is an involuntary exit from a role, whereas a founder exit via an IPO is a typically voluntary decision. So the main difference is the involuntary act to leave and the voluntary act to leave. There are 3 different exit options for founders. There's the full exit, means founder sells his equity and has no managing position within the company anymore. The second option is the financial partial exit. It means the founder sells his equity, but still fulfills some duties in the company within the top management. So he still remains the CEO, but sells all his assets. And the last option is kind of the opposite. It's the managerial partial exit. And it refers to a situation where the founder keeps his equity or his shares, but leaves the company. So he is no longer related to the company, or at least not in the top management position. And by that, we're always talking about, when we're talking about the financials and shares, we're talking about above 3% or below 3% threshold, because this kind of is an indicator of how big your involvement in the company is within. If you're above 3%, then the company has to report you as a single investor with a high equity in the company. Based on that, the authors build 3 hypotheses they like to justify within this paper. The first one is, the lower a founder's power at an IPO, the more likely he or she will fully exit from the venture via IPO versus maintaining involvement in the venture. So in short form, low power, high chance of exit. The second hypothesis is frustration mediates the relationship between a founder's power at IPO and his or her likelihood of fully exiting via IPO versus maintaining involvement in the venture. That is, a founder's power at IPO is negatively related to frustration, and frustration is positively related to full exit. The short form, you're frustrated, you leave the company. And the third hypothesis is, a founder's power at IPO has a weaker association with his or her likelihood of a partial exit, managerial or financial, compared to a full exit from the venture via IPO. And now I like to talk about the method the author used to get the empirical data and conducted their studies. So in fact, they conducted 2 studies. The first study is an observational study with archival data from the London Stock Exchange to test the main effect in a large sample. The second study is a lab study consisting 2 randomized experiments with entrepreneurial decision makers. And within that, they had 2 experiments. The first experiment was there to test causality of the relationship between founder power and both full and partial exit after IPO. The second experiment basically replicated the design of the first experiment, but additionally tested if frustration mediated the relationship between power and full exit. The variables they used in the first study, so they did a linear regression model. These variables they used are dependent variables, independent variables, and control variables. When we're talking about dependent variables, we're talking about basically 2 years after the lockup period. A full exit means they leave the top management and has less than 3% equity, as mentioned before. And the same with the managerial partial and financial partial exit. The independent variables, we're talking about the different sources of power, like mentioned before, structural power, ownership power, expertise power, and prestige power. And they also had control variables to test if the data they use is actually sufficient and not other variables coming in hand. Like, for example, is age a factor? For example, you could tell the older founders are, the more likely they are to exit their venture via an IPO. Or gender, maybe they're serial entrepreneurs, meaning that they just maybe like to found startups and they like the phase in the beginning, and after an IPO they leave the company to start a new company with the money they gained from the other IPO. But there are also other variables, like other founder powers. Are there other founders within the company who can basically carry the company or have a higher level of expertise, but also firm levels, like how old is the firm, what's the value of the firm, in which sector are they tech and biotech, which are considered, they have a higher valuation, or maybe there are even hot periods of an IPO. Especially in this study, they found that within the years 2004 and 2005, there were more IPOs than usually. And the results you can see in a lot of tables and charts. You can see one here, one over here, and a lot more. But I will not bother you by explaining everything by itself. I'm going to give you an in-depth look into it when we come to the conclusion of the paper. The first study has some limitations. That's why the author thought there's need for a second study. Those limitations are, for example, a lack of personal information that could affect founder's decision. For example, maybe the founder is married, and because of that he has to move to a different city, or he needs to raise his children there. So there are a lot of personal things that could affect the decision of a founder. There's no empirical established the direction of causality so far. They exclude the possibility that managerial partial exit were involuntary. So we talked about CEO dismissal, who's involuntary. And then here we're talking about, in theory, there's the possibility that a founder has to leave his company by force. And the last one, the last limitation, is to capture mechanism for power exit relationship, which provides so far no answer for the second hypothesis. The second study basically was two big laboratory experiments where they randomly assigned participants to conditions of high versus low power at the IPO. So they created two scenarios. One, the participants have low power. So after an IPO, they are with low power in the company, and the second is with high power. The first experiment was there to test the causality of the relationship of founder power and both full and partial exits after IPO. And for that, they had 181 participants involved in the entrepreneurial ecosystem. The second experiment basically replicated the first experiment and was there to test whether frustration mediated the relationship between power and full exit. For that study, they had 190 participants who were enrolled in an MBA program at a London-based business school, and they were somehow related to the entrepreneurial ecosystem. Either they were working in it, they were like founders back in the days, or they were some other way connected to the entrepreneurial ecosystem. And again, there were a lot of things we basically learned about that, displayed in this table, or this table, or this table, and a lot of more tables. And now in the discussion part, we will draw some insights we gained from the data and the two studies conducted. So first of all, IPOs create a great deal of uncertainty. This is pretty clear, and it is definitely a new challenging situation for all relevant stakeholders. Roughly 60% of all founders continue fully after an IPO. This is a quite interesting figure. So only 30% think about an exit. 24.6% of all founders exited their venture fully after the IPO. So there were no financial involvements and no management involvements anymore. Roughly 10% exited their company but remained their equity position. So they kept the financial stakes but did not continue working in the management team. And roughly 5% sold their shares but remained in management. Founders with less power are more likely to exit fully. This is an interesting insight we can draw here. Frustration mediates the relation between founders' lack of power to fully exit. Power is more influential on full exit rather than partial exit. And financial partial exit has non-significant correlation to power. So this is also quite interesting fact, which clearly shows that founders kind of think different when it comes to money. So they just see the money or financial gains they potentially get after and go after them. And the last is the managerial partial exit are positively related to founders' age, and especially when it comes to serial entrepreneurs, then the chances that they leave the managerial part is high. Now we're talking about the theoretical contributions and the practical implications. And in the theoretical contributions, less scholars have focused on founders exiting their ventures. So this is a new contribution. They also draw insights into entrepreneurial decision-making. The event of an exit is much more nuanced than expected, and what previous work shows us. Partial exits find recognition in the literature. This has not happened before. Exploration of power from a different perspective. This is also a huge gain and a huge theoretical contribution to just saw this thing about like power, how it evolves in an exit situation, or how it influenced the exit situation. And lastly, the introduction of an emotional component, namely frustration. When it comes to the practical implications, we are facing a rich versus king dilemma. Means either you can have a lot of power or a lot of financial gains. For investors, but also for founders, it's important to know that reduced power would cause frustration and lead to an exit. So in this case, especially goal management or expectation management is kind of key to steer the emotions in the right way. When it comes to future research, the authors gives us a wide topic where they could, future scholars could potentially put their research field in, so they could explore interrelationship of the power dimensions and their relationship to both founders, frustration and exit, and, for example, how financial gain might tie into frustration. Thank you very much for listening, and hope to see you soon in class. Thank you.